Good afternoon, everybody. Good afternoon. Thank you for being here. Those who are able to attend in person, we're happy you're here. And then those who are not able to make it in person and you're viewing this as a recording, if you have questions and or want to discuss any of the points that I'm going to go over today with me, you can feel free to reach out at any time because this is a lot of information. And as I was preparing for this training today, which will be on understanding home finance and how it works with the contract of sale, it does kind of lend itself, pardon the pun, but it does lend itself to a two-part training. So I'm saying here now that today we will go over the overview of home financing and the types of loan products that are out there and why it matters to us and so forth. And then we will get into more detail in August. Um, we just can't cover all of lending in one training session. So this way you can watch this recording or participate today and then anticipate in August having a follow-up, a part two. With that being said, I have a job aid that I'm going to share with you now. It will be mailed to you at some point between now and the end of the month so that you can reference this and have it for your own sake. There are some tweaks in here that I'm going to be making, but for right now, this is what it looks like, and this is what I will be teaching from today. As real estate agents, it's really critical and very, very important that we understand the finance part of the sale. And sadly, I know because I do teach the pre-licensing course, we can only go over so much in that pre-licensing time, and you don't really have any real life experience to put it to. And so we leave it up to uh, you as an agent and your brokers when you join a brokerage to kind of give you some more guidance. And sadly, this is often missed because what happens is when you do get your license, as you all probably already have figured out, it sometimes is many months between getting your license and actually going to a settlement table, let alone having a contract with a sale, with a transaction. So you're not utilizing your understanding of finance. And even if you have bought a home, even if you have used one of these loan types, it is very different as the agent. And we have to understand why a client might be using one of these loan types, when to use, because sometimes they will qualify for one, but we decide to change types of lending, or the lender suggests, hey, I'm moving you from conventional to FHA. Why would that happen? When would that happen? And how do we as an agent address all of this? So these are all questions that we need to be focused on and things that often get missed by agents and especially new to business agents. We also at times find experienced agents that don't have all of the information or don't remember all of the information. So that's what this is all about today. This job aid will come to you, and I think you're going to find that it's a great resource. I am also trying to get it down to more of a one pager for you. But let's start at the top and talk about the three main loan types that we have. First of all, we have, and you've probably heard of these words before, conventional, FHA, and VA. So what are the differences between conventional FHA and the VA loan products? Well, number one is the down payment. As you will see here on that top part of the chart, there's if you're using your VA benefits, and by the way, VA is a benefit. This is for the individuals that have chosen the military and have served their country, and this is one of the benefits of doing so. They get to use the VA loan, so it is specifically for those individuals. And one of the benefits is you don't have to have a down payment. I mean, hello, keep your cash in the bank, right? That's amazing. But that's not open to you if you're not in the military or have not been in the military and aren't qualified. And we're going to talk a little bit more about that in a few moments. An FHA product usually is 3 to 3.5, sometimes a little more percentage down. And if you're conventional, it's 3 to 5%. We also know we have this thing called PMI and our credit score. So we're going to talk about those as well because a lender isn't just looking for how much money you have in the bank. A lender is also going to take into consideration whether a buyer has what their credit score is, how much money they have in the bank, and their entire portfolio as an individual in their financial life, right? They're looking at everything. So if a person has a very good to above average credit score, we usually consider that to be in the upper 600s, anywhere to the 800 credit score rate. Hey, they are well qualified. This usually means that they have low debt to income, they pay their bills on time, usually they have a good flow of income, and so they qualify more for a conventional. But as it is life, some of us don't have that opportunity, and we run into some credit issues along the way in our financial life, and we might be below that 700 credit rating, at which point we automatically know they're most likely going to qualify for an FHA product because these FHA products are specifically for those people who have some credit issues. So we're looking at people with in the 500s. They're most likely always going to have to put down a down payment of some kind or need some kind of down payment assistance and the like. Of course, if we're looking for the VA, then there's no minimum. And lenders do typically look for above 600, but because there's no minimum and they're using the VA product, we know we can see a variance there of their credit score. If someone's using that conventional product, there is most likely going to be a PMI, that's a private mortgage insurance, and that's if they put less than 20% down. One of the myths, of course, is that you have to have 20% down in order to qualify to purchase a home. That's not true. That's a myth. And so it really determines whether you're going to pay insurance. Now, for all of my newbies out there, why would we be paying mortgage insurance? Well, what happens if you can't pay for your insurance? Or your mortgage payment? What happens if you actually need to? Let me let a few people in the room. What happens if you have a problem? And we see this a lot with people who have variable income or people who have less income, lower credit scores, because this has been a problem. The history of how they manage money has not been steady. And so we're going to charge you a little bit of an insurance premium because you haven't been saving your money or able to save your money. However, that is something that is short-lived. So that 20%, it's called the 80-20 rule. Here it is in practice and lending. You'll hear me talk about the 80-20 rule often, is that if somebody has saved 20% of what they owe for a home, a whole mortgage product, right, the entire amount that they owe, then there's a high likelihood that they're going to continue to make payments and see it through to 100%. If you get someone who hasn't saved 20%, doesn't have that amount down, there's a higher risk that they won't be able to see all of those payments through to the end. Now, if I put my lender hat on and I'm about to lend you three, four, $500,000 or so, then you best believe I'm going to verify your credit score, the amount of money that you have, and I would want a little bit of reassurance that you're going to pay me. And that's what mortgage insurance really is, okay? With VA, it's the funding only. There is no monthly mortgage insurance payment. And you can see a little more detail about that. We've already talked about then who qualifies for these different programs, conventional credit-worthy buyers. It isn't necessarily about the amount of money that you have in the bank. So I get that a lot. We go, well, I have a lot of money in the bank. Yes, and you're always late on your bills and you have a very high debt to income and a low credit score. So no, you may not necessarily qualify for conventional. That's where we would push them to an FHA product. And then, of course, the property itself comes with some requirements. A conventional lender is going to look for that a little less. They're hey, you can afford, if something happens to this house, you can also afford to put in some cosmetic updates. So they're a little more flexible on the property requirements for lending. But within FHA, we know that the requirements put forth by the Fannie Mae, Freddie Mac, and all of those products are that the property must meet certain standards. Now, if I'm out here and I'm an agent, especially a listing agent, but hello, you buyer agents, this is important for you to know too, then I'm going to probably want to know what those minimum property standards are. Because this box right here, this must meet HUD minimum property standards, can make or break a deal. And we've had a few come through the Maryland office recently where this has become an issue, where the house did not meet the property standards. So we want to focus on here just a little bit, and we will. And then, of course, if it's a VA product, then they have to meet VA standards, and the appraiser is the one who really kind of determines the property requirements. Remember, even though your buyer is paying for the appraisal, that appraisal is really not for them. The appraisal is for the lender. They're the eyes of the lender. They're the ones going to the property to see what it's like, if it meets requirements, and hey, Mr. and Mrs. Lender, the bank, is this worthy of the amount of money that you're about to put up for this loan? Okay, so again, if you always want to think about if you were a billionaire and were handing someone three, four, $500,000. What would you want the property to look like? So that's a overview of the three, but I really want to get more into the details of the different loan products. Let's talk about this idea of the conventional loan. It's not government backed. Now, we're not teaching all about loans today, but what I will tell you is that conventional loans are not sold on the secondary mortgage market. They are usually held exactly by the lender who lent the money. And so, anybody who's ever had a home mortgage, often you'll hear people say, well, I don't know who's servicing my loan. They keep selling it off. It's a good indicator they're not on a conventional loan and that they're falling under FHA guidelines. But if it's conventional, most of the time they stay with their lending and their service provider stays the same. And there's no government regulation. It falls under a different set of guidelines than the rest. It's not sold to Fannie or Freddie. Okay. Now, there's some pros to this. Again, no mortgage insurance premium up front. And once that property, or really it's the loan, once you've paid back the equity of 20%, that's 20% value of the home, then that PMI can be removed. That's not true with FHA. It is true with conventional. The law does say, and I'm not an attorney, you all know that hashtag I'm not an attorney, but we can also have that PMI removed by calling our service provider and saying, hey, I breached 20%. But that's long after we're involved in the transaction. So I never talk about that to my clients. I let that lender handle all of that conversation. But I know it. And so if I know we're kind of to the penny on what they can afford each month, I also know at a certain point their mortgage payment will come down ever so slightly based on the fact that they're probably paying a PMI insurance premium. Okay. So knowing that, I can kind of push the envelope just a hair, a little bit, like a fine line, if necessary. Now, again, flexible property condition requirements, cosmetic flaws aren't going to kill a deal. There's lots of term options out there for conventional, everything from 10 years up to 30 years and up. Now we are starting to see a few that are hitting 40 years. And then ARMs, those flexible, those adjustable rate mortgages are available. And we hear a lot of people poo-poo ARMs. I wouldn't do that if I were you. I wouldn't have an opinion. I would just let your lenders and your talk with your clients and let them make their own decisions. However, ARMs are a great product and they're fantastic if people can afford them, and we see them a lot in conventionals. Okay. Conventionals also can finance vacation homes and investment properties. This is really important for those who are getting second homes, third homes. This is important because sometimes FHAs won't, and so they can always find a conventional product. faster appraisals because why? There's no government agency involvement. So anytime we can get away from the government being involved, things tend to move a little faster. And then the loan amounts are much higher for conventional loans. So conforming loan limits. Okay, this is the amount of loan that can be made. And this is regulated. This is one of those regulated areas. And this really comes down to where the property is located. So when we're looking at Maryland, if I were to take, I don't know, let's say a 4 bedroom, 3 bathroom house on an acre of land, and I were to put it in, say, I don't know, center of the state, Howard County, my conforming loan limits would be much higher. If I take that exact same property and I put it out somewhere, say, Wacomico County, Dorchester County on the Eastern Shore, those loan limits are going to come way down. So the cost of living in Howard is so much greater than it is in those other counties. And that is one of the things that goes into the loan limits. Now, how do I know? Well, I've been doing this for a while, number one, but number two, I ask a lot of questions of my lenders. And if you work with a really good lender, they will often send to you when the conforming loan limits change, they'll send you a little chart, or you can always ask them, hey, where are the loan limits for Howard County, Baltimore County, Frederick County, and the like? There's also a jumbo conventional loan available. This you could get a product if it goes above. So for instance, in our example here, we see 766,000 and some change. What if I'm buying a home that's, let's just say 996,000? Well, you could probably get a jumbo conventional loan for that. It comes down to lending and qualification. Now, what we're really interested in the pro list is that this is usually considered the strongest offer type in a competitive market. Some of you might want to argue with me that it's cash. Now, cash is always king, they say, and maybe that's true. However, I will be honest with you, I've had sellers that say, no, I don't want to be bothered with somebody buying cash, especially at a higher price point. Why? Because they don't have to necessarily prove that they have the cash until we go to settlement. What's nice about conventional is you know that person has been vetted by a lender and that they have met certain requirements. It also indicates how serious they really are. And so oftentimes I know in 2020, we saw a lot of people trying to pay cash and then you'd lose a deal because they didn't really have the cash. It was like they wanted to get an offer in, so they offered cash, but they didn't really have cash. And you lost all that time on market as a listing agent. So not necessarily cash is king. It really comes down to the deal. But if we're looking at a loan product, conventional generally points to the strongest offer type, okay? Especially over FHA. There are some cons, believe it or not, to using a conventional loan product. One, you have to have higher credit scores. So if you do have somebody, and often we get people who've maybe gone through a divorce, inevitably you go through a divorce, your credit rating drops for a while, right? Maybe they've had a little bit of a financial hardship. Maybe they lost their job. They were unemployed for 3 to 6 months, something of that nature. You will see dips in their credit score. And so the challenge with when we see a person's credit score going from, 600s on down, 7, now it's back down to 6, up to 7, down to 5, you get the idea, then it really suggests that they're not as strong a lender as possible and that they're not as smart necessarily with their money. Tabitha asked a great question in chat. She says, do we have to ask for proof of funds when accepting an offer in Maryland? I highly suggest that you do. And don't kid yourself. Those proof of funds can be totally modified. So I dealt with an offer a few years ago where someone used someone else's bank account, pulled it into a Canva-like situation and put their own name on the bank statement. What more proof than we have than a bank statement? So yes, you would want to ask for proof of funds if you're playing with cash, but there's no guarantee that cash is going to be there in 2 weeks, 3 weeks, 30 days, whenever the close is. Tabitha, thanks for your question. It's a great one. Let's continue with our cons of conventional loans. PMI, Again, you're going to have that private mortgage insurance if it's less than a 20% down payment. There are much stricter DTI, that debt to income limits, versus government loans, where government loans allow us to have higher DTI, conventional not. And depending on the conventional lender, it can be really, really strict. So take that into consideration. Borrowers with lower credit will then pay higher rates, and they're usually paying a higher rate than an FHA borrower. So even though they've gotten this conventional loan, it might come at a higher rate. So you have to ask, is that really the best product for your client? Again, not for you to decide, but certainly we can give some suggestions and we can ask some questions that will send them back to the lender to ask some questions of their lenders. And then there are longer wait periods after a major credit event. So if there is a foreclosure, if there is a bankruptcy, it takes longer for those events to come back up versus FHA, right? We're going to look at it a little differently than we are as a conventional loan product. So I used to think, one of the best ways to look at it is a conventional buyer is someone who usually has a steady income, good credit, low debt. And I can ask questions the day I meet you that are going to tell me what I need to know without me even having you talk to a lender, right? So you can ask, what is your debt to income? Do you have a lot of debt? Do you have a lot of credit card bills? Are you on time? All of those questions will lead me to believe kind of which direction we're going. Of course, I would suggest to you all you work with a good lender and let them do all the homework for you. All right, so here's some talking points if you're working with a buyer. With your strong credit and 20% down, conventional usually offers the best what? Long-term cost, right? So we want to let them know that. This is why we ask certain questions. And even though they have maybe 3 to 5% down, they can request that PMI be removed. So again, it answers to that myth that you need 20% down to buy a home. That's not true. It's a myth, and it does go away. And then the most important bullet point on this talking point is that if you are a conventional buyer, it says to the seller that, hey, I have a strong buyer here, and it could win out in a multiple offer situation. So I recently worked with one of our agents, and their client would qualify for FHA, and they also qualified for conventional. And when asked, I said, it sounds to me like you're about to go into a multiple offer situation. I would recommend that you get this offer as a conventional buyer. And eventually, what happened is we had to change to FHA. By that point, we're under contract. It worked just fine, and we got them to the settlement table. But it was that conventional that won the bid. It's what got us the contract. Okay. So, and they qualified for it. So it did not end up being the best product for them. FHA did, but did get us the contract. All with lender approval, all with lender conversation. So the lender was involved in that entire transaction. By the way, if you do have any questions, feel free to put them in chat. Welcome to all of you who've decided to join us today. I love having you here with me in person. So jump in anytime if you have any questions. The next product we want to talk about is the FHA loan. By FHA, we mean that this is backed by the Federal Housing Administration. Remember, the government really does not lend money. The government regulates money. And so any money that is backed, any of these loan products that are backed by any of the administrations, for instance, USDA being another one, they don't loan the money, they regulate the money, and they ensure that the money is going to be there for the life of the loan, right? So we can afford to lend you the money, essentially. Right? What is the FHA loan product designed for? Well, one, buyers with lower credit scores, smaller down payments, and often first-time home buyers choose FHA products. Often first-home home buyers are often younger, maybe newer in their careers, the lower end of the salary, chart, if you will. And so therefore they don't have a lot of history of credit. Even if they have good credit, they may not have a lot of years of history. And so therefore, they're a little bit more of a risk in terms of the lender's eyes. Pros, lower threshold of credit, lower down payment. Often we can get some down payment assistance either from the seller and or different special programs being offered by county, state, etc. 3.5 minimum down payment helps with their limited savings, more lenient than conventional loans when it comes to that debt to income ratio. Some lenders, as you see, will allow upwards of 57%. Don't quote me on that, but I'm pulling this information, so I'm putting it all in a chart for you. That's not my saying, but where we're pulling it from some of my sources. Greater flexibility following credit events. So again, if there are, notice we've added to this list. In conventional, it was bankruptcy and late payments or bankruptcy and foreclosure. Now we're saying bankruptcy, collections, and late payments because collections and late payments are what kill you and pull you right out of conventional almost instantly. You have a lot of collections and late payments. I can almost guarantee conventional is probably not going to be a product that you qualify for. Assumable loans, buyers can take over FHA loans at the original rate. So we're not going into assumable loans. We're not even touching that in this training. However, this is a pro of the FHA loan product. Gift funds can cover 100% of the down payment. Now, this is really, really important for first home, young home buyers, especially if they're really squeaking to come up with down payment money. You can imagine, and I hope you all are, that when a buyer has to put out 10, 12, 14,000 more dollars and they're wiping out their savings, one of the things we should be reminding them of is that, you got to move and that's going to cost some money. So you're going to most likely have to hire a mover and so forth. So plus home inspections and all of the costs that come with buying the home, not just getting the loan product. So it sometimes is helpful if they are younger, maybe they have a family member or a very close friend who could cover the down payment. The FHA product does allow 100% of that down payment to be covered by gift. So that's an important distinction, and one that I think agents sometimes fail to mention. You know, often the borrower doesn't want to borrow money. They don't want a co-signer, of course, on their property, on their purchasing of their home, but there isn't anything saying that they couldn't get a gift of funds for that down payment, which could save them 1,000, 2, 3, 4, $5,000 and keep it in their bank account. They're going to need that. So something to keep in mind. And the seller. Why not ask the seller to contribute, especially if it's a first home buyer? Could the seller contribute up to 6% towards closing cost? Of course they can. And we all know what the largest amount of closing costs are. It's our commission. So that conversation on both sides of the table, if I'm representing a seller, then I want to have that conversation day one. If we have an FHA first home buyer, would you be willing to contribute to that individual's closing cost? It would really help get your home sold and open up possibilities. That's the conversation. If I represent a buyer, I don't promise that the seller is going to do it, but what I can say is we could ask the seller to contribute some of the closing costs and see what they say. And it's good to know that if it is an FHA product, the seller can contribute up to 6% of those closing costs. Okay. There are some cons. With every good, there comes a bad, I suppose. There are some cons to using the FHA product. Number one, mortgage insurance premium. Okay, so there's an upfront cost and an annual percentage of MIP. And if that payment is less than 10%, that MIP lasts the life of the loan and cannot be removed. So that is something to keep in mind, that mortgage and premium insurance. All right, loan limits may fall below the purchase price in some markets. So that means that we're paying more than the purchase price. And property must meet the HUD minimum property standards. So this becomes a big problem. One of the biggest right now that I've been seeing on a couple of our deals has been flaking paint. When you're walking around as a listing agent, one of the things you should be looking for, and I do use the word should here, is issues that are going to kick me out of an FHA loan product. So if I walk into a home and it was built in 1956 and I see paint flaking in the basement or off the siding of the house, then that becomes a major problem. And I immediately am going to say, look, anybody with the human eye is going to see the same thing I am, which is paint flaking. And with that, an appraiser is immediately going to kick this out. Why? Because of lead. So we're either going to have to correct that before we go active or understand that this is going to become a problem for an FHA borrower. Mike in the chat says, with FHA, is there also a 20% equity limit to the PMI removed, or is it the limit difference? So there is for it being removed, Mike, the law says, and I believe, and I'm not, 100%, Justin's here, maybe he can correct me if I'm wrong, but that at 20%, you can actually call and have it removed. But I don't know on the FHA. I know with conventional, that's 100% true. And at 22%, the law says it drops off. So it automatically comes off. Justin, do you mind jumping in here and answering that? Do you know? You're on mute if you're participating. Justin, can you hear me? Can you answer the FHA question? He's like, what? Is she talking to me? All right. Well, we'll get in it. Mike, we'll get a solid answer for you on that. It looks like he might have taken a call while he's watching the Zoom. So we'll get a clear answer on that and get it out when we send out the talking points. Okay, some more cons are that the sellers have negative perceptions of an FHA offer. Now, where do you think that the seller gets a negative perception of an FHA loan? From agents. We set the tone for what the sellers believe. So if we say to a seller, yeah, you don't want an FHA offer, right? You don't want somebody with an FHA. We've immediately put in their mind that they're not looking at FHA products. We're not going to look at a buyer with an FHA. That's not strong enough. So be careful what you're saying to your sellers. That's not true, by the way. Just because they have an FHA product doesn't make them any less worthy or any less valuable as a buyer. It simply means that the product that they qualified for was FHA, and that worked best for them for what is happening and the property that they are purchasing. Okay. So it doesn't mean that it's inferior in any way. It just is. Okay. It just is. And another big talking point specifically for us as agents is that condos must be approved by the FHA. Now, this is a major problem. And many, many buyers, we get caught up in showing people properties and we forget to involve the lender in the conversation. If your buyer is not told the lender that they're looking at condos, and then especially in urban between Baltimore and DC, where it's tight, 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 tight money, tight quarters, and very few homes to choose from, it's not uncommon that someone breaks down and says, I want a single family. They only qualify for more of a townhouse. You're looking at townhouses, and really what they end up looking at are condos. Some of those townhouses do also fall under the condo category. If that happens, you must call the lender and verify that that condo is on the FHA approved list. Okay, it's very important that you do that. If it is not, then you cannot use the FHA product. And if you can't use the FHA product and they don't qualify for conventional, there is no hope of them getting into that home without cash. Okay. So that's really important. And over the years, I've seen agents get so uh, dismayed and buyers get so disappointed because their agent never called the lender. Okay? So make sure you're calling the lender. Condos must be on the FHA approved list. And the FHA requires the condos to reapply for FHA approval. I think it's every year or two. So it's possible that what wasn't on the list now is, or what was on the list now is not. So you can't assume that you know the answer. Let the lender tell you. Never assume. Here's some talking points for our buyers. FHA is a great path to home ownership. If you are talking to them for the first time and you're getting a sense of their finances and you hearing some red flags, higher credit, a lot of credit cards, a few late payments, those kinds of things. 1099ers often fall in this category, by the way. All of us as agents that make our money through commission fall often in this FHA category. Then we want to be talking about the FHA product, right? It's a great way to get in. Also, make sure you are talking about that mortgage insurance over time, okay? And that in a high rate market, look for assumable, again, FHA loans. We are seeing a little more of this, even though we're not really going to go into it in this training. We are seeing this pop up more and more often these days because a lot of people bought in 20 and 21 when interest rates were so low. Now, some loan limits just for your reference. I pulled 2024 as the most recent. There are low cost areas around 498, high cost areas around 1.1. And then if you're looking outside, this was done more for national purposes, but anyway, Alaska, Hawaii, Guam, etc. have very high limits. Now, part of the reason this is in here is because of my military affiliation and working with people who are moving to other parts of the country outside, obviously, of our local Maryland area. Which leads me to our third product, which is the VA loan. VA backed by the U.S. Department of Veteran Affairs. Again, Veterans Affairs is not lending money. They're just backing it, okay? And look at what this says. And I really, well, for those of you who don't know, let me just in transparency tell you why I'm so harping on the VA loan product. So for a couple of reasons. If you live anywhere between really the shores of Maryland, anywhere in the state, but specifically the center part, we have a lot of military. In Frederick County, we have Fort Detrick, we have Aberdeen Proving Grounds up in Harford County, Fort Meade in NSA down in Howard County, all the way down. So we have everything Coast Guard, Marines, everything you can imagine. A lot of military, a lot of military, a lot of commuters into DC military. So we see a lot of VA loan products coming by through us. One of the things, that's one thing. Number two is I'm a Navy mom. So my son is in the Navy full time. And so it drives me nuts when I hear people dispel all these myths about VA loan products being so weak and you don't want a VA loan buyer. The other thing to keep in mind, especially for my Pennsylvania friends, is listen, Maryland is very clear. We have a protected class over and above the federal, and that is source of income. We also have added military status to our protected classes here in the state. So if you didn't know that, please make note of it. And so therefore, we cannot be talking negative about VA loans. Source of income. It immediately points to source of income, number one. But number two, military status. Those are two protected classes. And look what it says. Not only is this loan backed by the Department of Veterans Affairs, it is one of the most powerful mortgage products available if they qualify. Powerful for the borrower. So again, it drives me a little nuts because we hear listing agents all the time saying to sellers, we don't want any VA loans. Why? It's actually one of the most powerful mortgage products, and it's backed by the Veterans Affairs and almost a guarantee that you're going to get this person across the settlement table with very little hassle, very little. So who qualifies? And again, this is a pretty high level form here, but active duty, okay, they have to be active duty service members. In other words, they had to do 90 days during wartime or 181 active days during peace times of peace. Veterans who meet their minimum service requirements. National Guard and Reserve, those are individuals who did 6 years of service or 90 days active under qualifying orders. This also could be a surviving spouse of veterans who died in service. So a lot of people forget that, and they forget to ask. If they say, well, my husband, my wife died, they were in the military, but ding, 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 have you considered telling that to your lender and looking at a VA product? Okay. So that's really important and one that often gets overlooked. Now, there are a lot of pros to the VA loan product. Okay. No down payment required. We already went over that. 100% of that can go into financing. No monthly mortgage payment. Okay. Not at all. No PMI, no MIP, no monthly mortgage insurance. They're competitive interest rates, usually below conventional. Okay. Usually below conventional. Just today, I sent a military member to a lender and they called very excited and they said, oh, I qualified. And I was kind of chuckling, going, yeah, I knew that was going to happen, right? Not a surprise. They were surprised. I don't know why, but they were. And they quoted their interest rate. And I was like, what? You want to tell me that again? Because it was so below the couple of conventionals that I've had this week cross my desk. And I was like, wow, what a great rate. Very competitive interest rates. They have limits on closing costs. There's a lot of things that you cannot charge to a veteran. At some point, I will provide a list of what those things are because it has changed in recent years. Just know that the VA did change after the NAR lawsuit in 2024, and now our commissions can be rolled into the loan product. So that was a big issue because that was one of the questions. Well, we can't charge to a veteran, but how do we get paid? That kind of situation. So I'll send out either this month or with next month's training, we'll do a little more in that and I'll make sure you get some good information on that. Assumable loans, VA loans are assumable. There are no prepayment penalties for the veteran. So if they do borrow and they are able to prepay that loan quickly, unlike conventional and FHA, there are no prepayment penalties. The loan origination fee is capped at 1%. And they can use this benefit more than once. This is not a one and done. And veterans don't often know that. In fact, a lot of agents don't know to tell their veterans that. So when I'm dealing with someone who is currently in the military or retired or did any kind of military service, again, I never promise, but what I do say is, hey, have you used your VA loan benefit? And if they said, yeah, I already used that on my first house or I used it before, you can use that more than once. We should really talk to your lender about that and see if you're eligible to use it again. And then we have streamlined refinancing for rate reduction. So if they buy at a higher rate because of economic times, then we do have a streamlined refinance opportunity for them to lower their interest rate. A lot of pros to using a VA loan, a lot of pros for the borrower. Now there's some cons. Okay, it is only available to eligible veterans. That's number one. The VA funding fee, there is a funding fee from the VA. This can be waived. We'll talk a moment about that. VA appraisals can take longer and are a little stricter than conventional. Now, I have actually encountered the opposite with VAs, and probably because of where we are. Most of my VA appraisals In fact, I sold a guy a house a few years ago, and I'm still shocked because to me, there was an issue with a handrail missing on the back steps. Didn't catch it. Appraiser let it go, never caught it. Now he's looking to list that home again and had me over the other day, and I laughed and I said, gosh, I remember this back porch. You still haven't put up a handrail, and it is still treacherous because of the height of the steps and so forth. And he laughed and said, yeah. And I thought, I wonder if it's going to come back this time on an appraisal, because it didn't before. So I think they're stricter in some things, but really it's not all. And I find FHA product appraisals being much stricter than VA. So I don't know. I disagree with that con just slightly, but that's my personal opinion. Seller education sometimes needs to happen to overcome those misconceptions. Again, if a seller is not educated and they have a negative view on the VA loan product, our job is to educate them. So if you're a listing agent, please make sure that you are coaching your sellers on the truth and not on myths, not on myths, okay? Now, one of the biggest cons of the VA product is that it can only be used for a primary residence. So yes, you can use it more than once. We see that as a pro, but it has to only be for a primary residence. So if they are going for an investment property, they cannot use their VA benefits for that. Okay. Some talking points for our buyers. If they've served at all, so have you served in the military? Then, and the answer is yes, then this likely would be the best loan product for them. Okay. The funding fee is one time, it's not monthly. And this is the 2 points that we need. Okay. Number one is they need their certificate of eligibility. They get that from the Veterans Administration, their COE. And they should get that early. Okay, they can get it through their lender. They can pull it through military online platforms. The idea is that not all military service members are equal. Okay, now I've learned this just from being a military mom. I did not know this prior to that, if I'm being honest. And that is that even though you might have a person who served, let's say, 10 years, and another person who served an equal 10 years, those 10 years may not be seen as equal according to their benefits. It's not for me to say, it's not for me to judge, and it's not for me to say anything about it or lend my opinion one way or another. What it is, though, is for me to say, great, let's make sure you get that certificate of eligibility and let's get it to your lender, okay, so that the lender is clear. And that's a conversation with the lender. And then don't let sellers turn away a VA loan. Okay, they're very reliable. Uh, they want to work with a very good VA lender. That's the other thing. Not all lenders understand the VA process. Not all lenders are qualified. You're looking for a lender that has that military background, not that they were in the military, but that they've done the training around the VA product. Okay. Uh, if you think you're going to be working with a lot of military, I highly recommend that you consider the, is it MIP military, specialist in military sales. Those are some initials that you can get. It will open up a lot of resources for you to work with the military, and you can get that through NAR, often available in our area. Now, for our listing agents, what are we going to look for when we're listing a home? Because the loan type affects your listing strategy. It affects the seller expectations, the repair negotiations, and the risk of appraisal. Okay, so you want to know these. Here's some general list considerations. Ask up front. You know, we should be asking a lot of questions. But number one, are there known repairs or deferred maintenance? You know, which type the home will realistically support? If there are known repairs and a lot of maintenance coming that has been delayed, then we may not be able to get certain one of the loan products. Okay. Notice the price point and the location does influence the buyer pool. So we just talked about a few moments ago how high of a concentration of military we have in our part of our state. Well, knowing that if you got a seller who said, no, I'm really not interested in working with the VA loans, hello, why not? Because we have a high concentration of military, it's highly likely we're going to see a VA product and or one of the banks like Navy Federal, for instance. Though we all kind of cringe a little bit and we roll our eyes, we shouldn't. They're a big lender of military. Okay? Tower Federal is another one of those who are local. Understand the seller's time frame. If we know that FHA and VA appraisals can run longer than conventional, and the seller is on a very tight time frame, then going with a FHA loan product or a VA loan product over a conventional is going to matter. Because here's the news flash, everybody. Sellers, it's not just about the amount of money that they're going to net. We have to look at the entire picture. And part of the entire picture is what's important to the seller. And I just closed a deal personally where I put my buyers in a conventional product at a slightly higher interest rate, but it got them the deal. Why? Because the seller was on a really tight time frame. So we had a conversation with the seller on accepting a little less money on the sales price. Hello, got them a little bit of a savings and got them that conventional loan. Why? Because what was really important to the seller was getting out of that house so that they can close on their new home. They were on a really tight deadline. And the minute that listing agent told me that, I went ding, 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 ding. We're going to go conventional. And that's exactly what we did. So consider the timeline. That is one of a seller's consideration that's often overlooked. And a lot of agents think, oh, they just want to make the most money. Well, sure, don't we all? But that doesn't necessarily mean that's going to meet their goals and their motivations of why they need to move. Conventional products, buyers rather, and the seller impact. There are fewer appraisal headaches if we choose a conventional buyer. If we have two equal offers in front of us and one is conventional and one is not, please let your sellers know. Well, one of the things is fewer appraisal headaches, right? It's more on market value focused more than property condition focused. Peeling paint, dated finishes, worn carpet. Not so much a flag on a conventional appraisal, but will catch you almost every single time on an FHA. Okay? Sellers can generally accept offers without repair contingencies if it's a conventional, right? So I feel much more confident with a conventional buyer saying, look, if you're choosing not to get a home inspection, though I am encouraging you to get one, at least knowing they're a conventional buyer suggests that, hey, that becomes a little less of a concern for me. It is preferred loan in a competitive and move-in ready homes. Conventional is going to win out almost every time over FHA and VA. Okay. Continuing, if we talk about the FHA buyer and seller considerations, again, this is from the view of the seller. The FHA appraiser is working for HUD, so they're going to flag health and safety items every time. Health and safety. So you know that corner of the basement that no one knows if it's mold or not because we're not hashtag not environmental specialists, but we think, but we're not sure. Or we go into a bathroom with no circulation and we look above the shower and we're starting to see the black spots, which suggest mold is growing, right? That mold we all get in the bathrooms. Okay, all of those become red flags, and an appraiser's looking for those. They're going to be looking for the railings and making sure all the spindles are there. They're going to be looking at that back porch I mentioned earlier on my VA loan. That would not have gotten an FHA loan. In fact, he was a VA buyer, and that's how I knew we'd be okay with certain things that ironically he still hasn't fixed. Okay. So here's some of the common flags. Peeling paint, especially if we know it's pre-1978, lead-based paint, huge. Missing or broken handrails, broken windows, damaged doors, a poor condition of a roof every time. Any water damage evidence or any structural issues, okay? cracks in foundations, obvious shifting, that kind of thing. Any exposed wiring or electrical hazards, missing or inoperable smoke or CO detectors. Okay? They might be there, make sure they're operable. And by the way, a good appraiser is just like us. They can look at one and say it's a smoke detector and determine, hey, it's new or it's not new. So don't think you're getting away with anything by leaving an old one up. Know your smoke detector laws. Sellers may need to make repairs before closing. So therefore, as a listing agent, I hope you've had that negotiating conversation about repairs and credits in lieu of repairs. Escrow holdbacks sometimes allow for minor items. So sometimes if it's a quick to close and the seller doesn't, we can put some money in escrow. Sellers can specify in the MLS that they prefer conventional. So type of lending accepted, you can put conventional. You could say it right in the, we prefer a conventional offer. It's fine. Doesn't mean that that's all that's going to win. It's just that's what we prefer. Sellers can contribute up to 6% of the purchase price towards the buyer's closing cost, and we talked about that. For a VA buyer, some sellers considerations. One is VA appraisers enforce the minimum property requirements. Again, they say they're stricter than conventional and more similar to FHA, but really what they're looking for is safety, health safety of the buyer more than anything. There's some red flags. All structural and safety items that would flag under FHA are in place. Heating systems must maintain a 50 degrees. They're not going to allow a faulty heating. Roofs must have a reasonable remaining life. Crawl space active. Active pest and wood destroying organisms are required. VA is going to look for more of that versus FHA or conventional. Some non-allowable fees, and again, I'm going to tighten this up a little bit and get you a better job aid on this, but termite, lender required repairs, and so forth. So I'm going to leave that section a little alone because I'm going to update that a little. I do want to go on with the time that we have remaining and talking about more the strategies of the loan type. Okay, more of the strategies. With conventional, again, we say that, hey, it is a seller highest preference. So if your buyer would qualify for conventional, I would recommend that you go conventional in your offer. Okay. Lowest appraisal strictness and fastest timeline for closing. So again, this is where I use this to my advantage to win this last contract is because though I know they would have preferred FHA, I got it in, we got accepted because I was able to bring them conventional to the table. Okay, so it was the conversation and the strategy in the purchase. Also, maximum seller concessions, that's a really important one to consider. And the loan product overall is best for someone with good credit. It lends itself to a more competitive offer. They might have investments, looking for an investment property or a vacation home. Okay, so that's what your conventionals are best for. When we're looking at FHA, again, stricter appraisal, the timeline is 30 to 45 days. So I do love the agents that say we can close in 2 weeks, and I go on an FHA product. Let's see how that works out. And that's not usually the way that works. Usually it's 30 to 45 days. It's a little longer of a process. There is a maximum that the seller can provide, and that's 6%. And it's best for first home buyers, someone with lower credit, or having limited down payment opportunities. Okay, not a lot of cash on hand. They're not going to be able to do that large down payment. For VA, again, educate the seller. Cannot express that enough. It is strict on appraisal. 30 to 45 days. Appraisal time can vary. Also, the VA product can vary a little bit on that closing timeline, especially if you're using a good qualified lender who works a lot with the military. They sometimes can beat that 30 days, but it's still generally 30 to 45 day close. You can have a seller concession of up to 4%. Plus, you can ask the seller to cover those things are not allowed to be charged to the buyer. So that's another one that you can go after. And it's obviously best for veterans, maximizing their buying power. So really great opportunity there. Some tips and some misconceptions. FHA and VA are harder to close. No, they're not harder to close. It takes a little longer, but you're going to use a knowledgeable, good lender, and you're going to be an agent that sets expectations. And with those two, you have a winning combination. So it's not that FHA and VA are harder to close. It's that we have agents who aren't setting expectations, and we're not working with a good lender. Okay, imperative. VA buyers can't compete. Mike, will get to your question in just a moment. VA buyers can waive appraisal contingencies, they can offer above asking, and they can use seller concessions strategically. So this becomes really important for us as agents to understand all the variances. The minute you do, all of a sudden you became very valuable as an agent. Your negotiating power just stepped into play, and now you can really benefit your buyers and your sellers, quite honestly. Mike says another question, and I may have missed this, but who covers the non-allowable with the VA product if the seller refuses to? That's a great question. The answer is it really depends on what's being charged. So if, for instance, we couldn't charge a broker fee, guess who's paying the broker fee? Hint, hint, we are as the agent. Okay. So it really comes down to what is trying to be charged. You would want to know that list. So when you get that Alta statement and you review that Alta statement at the end, right before you head to settlement, you can look and verify that they're not being charged for anything they can't. Often title will waive, lenders will waive because they know they're working with a VA buyer. And like I said, there are many times that sometimes we kick it in out of our commission and we pick up the cost. Okay. We're not usually talking about huge amounts of money. It's often small amounts. And believe it or not, I'm okay with that. I'd rather pay a couple of $100s for a VA buyer to get the product done and get the deal closed than I would to squabble over what's affordable or not affordable or what can and cannot. Just take it out of my commission. Like honestly, it just is easier. It wins me the clients for life. I get a lot of referrals from that, and I know I'm putting somebody in the house that they need to be in. So at the end of the day, what's a few dollars out of my pocket? But that's my philosophy. You will choose your own. FHA, here's another misconception. FHA means the house must be perfect. Wrong. Cosmetic issues are fine. What they're looking for is health, safety, and structural defects. So again, flaking paint. It's so easy. Like you see flaking paint, it's pre-1978, you're on a listing appointment. We're going to want to correct that flaking paint issue, okay? Or understand we have narrowed down our buying pool. Putting 20% down is always best. Be careful. Listen to that language. Putting 20% down is always best. Well, no, it isn't. Cash, liquid, and investment may be more important than putting it down. We have to look at the whole lender. And guess what, everybody? That's not our job. It's the lender's job. Our job is just to understand and that we're not putting myths out there in the public forum. So if we say to someone putting 20% is always best, we don't know their whole financial picture. Who are we to say that actually may not be the best for them? So be careful of the language that you're using. You might say, we generally recommend having 20% ready to put down for a deposit. That's a different wording. Now I'm suggesting that you have that 20%, but I'm not saying you must, okay? Or it's always best. It may not always be best. Some pro tips, and Mike, thank you for your question. It's a good one. Some pro tips for agents. Always verify who the pre-approval is from and that it's the right product. Okay. A generic letter is not the same as approval from, say, a VA experienced lender. Okay. So Sometimes your buyers will come and say, "Oh, I've already talked to a lender and here's my letter." And it's some generic form or generic pre-approval form. We want something specific to them. And we want to know that they've talked to the lender and that they've given all the answers to all the questions. So it's not uncommon for me to say, "Thank you for that. Let me take a look at it." And I highly recommend what? You get a second and a third opinion, right? I mean, if I got a cancer diagnosis, you best believe I'm calling a second or a third doctor just to verify the diagnosis. The same is true for lending. We are talking about these people getting into a very long-term commitment. 10 years, 30 years of their life that they may not refinance. They may not ever have another opportunity to talk to a lender. They may not know to. So our job is to ask a lot of questions and to verify that we are putting them with the best possible lender we know and getting the best for them. That's our job. With listing, note in MLS remarks whether the seller will consider FHA or VA. So if we put in the MLS, just you can click conventional FHA, USDA, all those things. If you click those little boxes, is that good? Sure. But why not in the actual listing write-up say that the seller will consider FHA or VA? What you're suggesting to the general public is, and to us as agents, I've had the conversation with my seller. They understand the pros and cons of each, and they are ready to hear every offer. Encouragement to write the offer. That's really what it is. Encouragement to write the offer. For FHA or VA offers, include a lender letter that proactively notes the property's condition meets appraisal requirements. So you could save yourself a lot of hassle if you say already, "Hey, this condition meets." Sometimes with sellers, depending on the market and the property, I've actually had a pre-appraisal done at the seller's cost. We already know it's going to pass. I already know what price point it's going to be, and I already know what lending I can accept. Okay, so that's another strategy you may want to employ at some point. Know your local VA appraisal turn times. This is a quick call to your lender and just ask the question if you have a VA buyer. Make sure you've pulled that certificate of eligibility for your VA buyers, especially if they've used the VA product before, because I don't know all the ins and outs of VA benefits. I don't even profess to know. However, it might be something they could only use one time, or maybe there's an amount, a limit, or what have you. I don't know. So by pulling that certificate of eligibility, it tells me a lot. It tells the borrower a lot and the lender a lot. Okay. If you do find that you're getting into assumable loans, note the original borrower's VA entitlement is tied up until the assuming buyer substitutes their own eligibility. So if it's a VA buyer to a VA buyer, which we get sometimes in Maryland often, or the loan is paid off. Okay, so you want to know this before you advise your sellers. You got to know the information. All right, so that's the end of the pro tips. There's some other questions. Mike says, for very interesting, almost seems like an oxymoron that a 203K is an FHA product when typically there are those health, safety, and structural requirements. Yep. I would imagine those same restrictions would apply after the rehab, but not before. Well, after the rehab, so that's a great question. So for those of you who don't know what a 203K is, a 203K is what we call a rehab loan. It's an FHA product. And what it is really for those homes that need fixing up. They're not the ones that are like so far gone, they really need to go down to the rafters. These are the ones that are in very good condition. An owner has taken very good care of the house and the property, but it's fallen in some aging, some sign of the time it was built kind of thing, right? So for instance, maybe you walk into a few years ago, beautiful single family home in Baltimore City, brick. Lovely, lovely home, just absolutely gorgeous home. The kitchen, however, was from like 1950, in very good condition. Everything worked, very clean, well taken care of, and it was a 1950 kitchen. And it had other elements in that house that were from the 50s, like the electric system was still the original. Fascinating to see, but the buyer didn't have the money to upgrade, and this was a problem. So we introduced the 203K loan. What the loan did was allow for some of the updates to be rolled into the course of the mortgage. Now, I'm not going to go way into the 203K product, but that's really what it is. And it is, as Mike suggests, an FHA product. And yes, in that house, there were health safety concerns. In the basement, there were tiles on the floor that were dated in such a way that we knew probably full of asbestos. So we knew it was going to be environmental concern. But because you're getting a 203K loan, Mike, you also have to make sure that you're getting a contractor who is 203K approved. They have to be an approved FHA contractor. And so you can't just go in there with any old contractor, and you can't be a DIYer either. That's not approved. So you have to go get, as part of the loan product, you get a contractor that is FHA approved, and they come out and do a full assessment of the property. They write all of that up so that the lender, the buyer, everyone knows what's going to be repaired and at what cost. And then that adds into the 203K product. Did that answer? So we don't have to worry about the after rehab because at that point we've already gotten our loan product and they're on that loan product. Did that answer your question? Did you have anything else?
No, I didn't realize I could unmute. I've been typing the whole
Yes, imagine
time.
it's Zoom and we can unmute. It's great. Yeah. Did that help?
Yes, that helped. Thank you.
Excellent. Excellent. All right, so with that being said, now there are addendums for each of these. The intent of this training, in truth, was to go over the addendums, right? We were going to spend some time going over the FHA and the conventional and the VA addendums. I will save that for August. What I really would prefer to do today is stay focused on the type of lending. So again, if I go here to the top of my job aid, and I didn't realize I was still sharing, sorry about that. You don't need to see me anyway, it's all good. But this will be sent out. I can send it out to all of the Maryland agents will get it. It will go out with, Terry is going to send it out with the training that will go out, the copy of the link to the training here today that's being recorded. But I would encourage you to do a couple of things. Number one, I want to encourage you to take the time to go over the job aid. That's number one. Make sure you know the differences because it really lends itself to what questions you need to ask. It lends itself to what you need to do to guide and advise your buyers. It tells you exactly what you can help with the conversation with your sellers. If you need any help, if you want to go over any of it, you know how to reach me by now, I hope. So feel free to reach out and we can go over it. In August, I will do a second training and we will go over the actual addendums themselves, what's included, how to use them as a conversation, some pitfalls to look for, and where it fits in then to now what is your understanding of home financing. So it's a two-parter. Any questions, thoughts, concerns, anything you want to add before we end the recording? Okay. Well, it's a little early, but I don't think any of us will argue about that. Again, for those of you who came in person, thank you so much. Mike, thank you for your great questions. Always appreciated. For the rest of you who are watching this recording secondhand, again, I'm your broker in Maryland. Happy to answer any questions that you have. And Justin's another great resource for you if you have questions in PA. But understanding home financing is so key in negotiating contract. And for those of you who were scared about it or unsure, I hope this has helped. And the more you learn, the more you know, the better you can be as an agent. Okay. All right, everybody. Happy July 4th. Wish you all well. See you in August.